Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hixon Zuercher Capital Management.
And I'm Josh Robb, director of wealth management at Hixon Zuercher Capital Management. Austin, how can people help us with this podcast?
Well, first of all, we would love it if you're not subscribed, if you would hit that subscribe button so you get a new episode every single Thursday. And we would love it if you would visit our website and sign up for our weekly newsletter to get notified when those new episodes drop, with some highlights and show notes and things that are going on in that episode, as well as a direct link to listen to it. So we would love it if you would do those things. So Josh, what do we have going on today?
Yes, today we are joined with another guest. And today we're going to be talking to our intern, which we've done some in the past with our marketing interns.
Yep.
Today we're talking with our finance intern.
That's right.
And so Kate Newland is with us, and she is going to be asking us some questions. And again, like always, an open book, whatever you want to know.
Finance, not finance.
Is there. But first, Kate, tell us a little bit about yourself.
Yeah, hey, so my name is Kate Newland. I am Hixon Zuercher Capital Management's first ever finance intern. And
first ever means trial and error.
Yeah.
You're the guinea pig.
What do we do with this intern? She's been very gracious with me and working through as we learn the process of having a finance intern.
Yeah.
Well, you haven't messed her up too bad because she was willing to come on the show.
Yes, that's right.
Yeah. And at the end of this year, I'm going to be graduating from Ohio Northern University.
Polar bear.
Go Polar Bears.
Yep. Go P Bears.
That's what they call them. The P-Bears?
P-Bears. Yep.
That's
Yeah,
a
that's it.
funny name.
But yeah, that's me.
And where are you from? You from the area?
Yeah. I am about an hour from Findlay, Ohio. I'm from Lakeview, Ohio. So.
Okay.
And I won't hold that against you. I give her a hard time. I'm from a local area like Indian Lake area called West Liberty. So
Yeah. So you guys are rivals?
we weren't really rivals. I ran track against Indian Lake and stuff like that. My
Yeah.
dad worked at Russell's Point Honda.
Oh,
So we
okay.
were up there all the time.
I'm
There
familiar.
you go.
Yeah.
All
And
right.
there's, what's the pizza place I told you about?
Woody's.
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 Woody Burger. Oh my goodness. So good.
Yeah.
I love Woody's Burgers. So
All right.
I love
There you
the
go.
lake. I love the lake. I don't care
So
what I
you-
say.
For Austin, anywhere you go, the reference point
Is
isn't like the
food.
city or town name. It's
Oh,
like,
yeah,
where
are
was
you that
good
place
food I
with that
ate at?
restaurant?
That
Yeah.
one thing. So
Absolutely. So, Kate, you have prepared some questions. We don't know what they are at all.
Oh, wait.
This is actually completely live for Josh and I, and this floor is yours. So,
Yep.
yeah, take us away.
Alrighty. So my first topic is about Robo-Advisors.
Ooh, yes.
Ooh. I wish I had a funny joke.
AI of the future.
That's right.
Yeah, so I guess my first open-ended question is, what is your guys' opinion on Robo-Advisors?
Can Josh be replaced with low-cost advising?
Yes, I can.
Yeah, so, I mean, we both probably have similar opinions on this. I think for some people, especially young people starting out with very simplified financial goals, it can be very useful because it's generally quite affordable. It makes dollar cost averaging very simple through already pre-orchestrated models. And as long as your financial situation at the time that you're doing that is very, very simple, you don't need a lot of tax planning or income planning or specified instances like that, it can work. You're not going to get tailored to you recommendations because you're going to fit a bucket. And that bucket is generally very okay when you're young and adding money. That's kind of my opinion. Josh, maybe elaborate a little bit more.
Yeah, I've always had a problem with the term advisor with that because the Robo-Advisor, where they do their best and where I think they are very valuable is in asset management.
Right.
And so when it comes to choosing investments, rebalancing, all the pieces that are involved in managing your investments, a Robo-Advisor actually does a very good job because they're on some sort of programmed allocation and program schedule. And so when you add new money in, it knows where it should put it in because it looks at overweights and underweights. It does its job because it's all rules-based. Very easy, very simple. Where I think it falls short is that because it is automated, when it comes to giving advice, which an advisor should be doing, that's where you're going to see the shortcomings. So Robo-Advisors, I don't have a problem with if you need very simplified, rules-based investing.
Yeah.
So if you are not one to panic when things go down, a Robo-Advisor can be beneficial. What we found during especially this last downturn is that when things got rough and people had been using this type of investment and they needed to talk to somebody, there was no one on the other end to talk to. And they needed reassurance and am I doing the right thing? You push buttons and you get answers, but you don't get somebody there. Right. And that's a shortcoming. So will robo-advisors replace advisors? No, but I will see people who are maybe at this stage where they don't need long-term planning yet, where they're young and there's a lot of other things they're doing and they're not really focusing on that piece. It can come in handy. Or if you're someone who likes to do a lot of it yourself, but you just need a little bit of help when it comes to choosing when and how and rebalancing things like that, a robo-advisor would fit into that.
Yep.
Because you're, again, helping choose that stuff, but then letting something automate the ins and outs. So robo-advisors, I don't have a problem with. I don't see them as competitors to our industry when we're talking financial advisors, because they're not going to help you really with tax planning. They're not going to be helping with estate planning. Those are the things that you miss out on. Mm-hmm. And so that's why advisor seems a little weird to me, because the robot's not really advising you. It's using algorithms and programs to allocate you. And there's nothing wrong with that if that's what you're looking for. And I actually know advisors who use that as their management piece, and then they're the ones giving you the advice everywhere else. So I've seen it kind of merge together where they're using that kind of automated piece to invest, but then also being the physical advisor to help you through the tough times as well as planning. So yeah, I think they're a neat tool that over time, as they enhance and grow it, you're going to see more adoption of that, but it's not going to replace a person, especially when things get volatile. Because even when you look at Robinhood, if you give people just the ability to do things and you have some training to help them, when things get rough, they do like to talk to somebody to help them through that. And that's the piece that's always missing in that.
Josh, your job is secure.
Whew, it's close.
I know. The robots haven't taken over yet.
Have you guys experimented with robo-advisors?
We actually have. So we did look at the option for either accounts below our minimum or people just starting out. There's a couple different, again, it was kind of a hybrid where it was really just the asset management piece. We would still be the ones giving them advice, but then to actually put them in investments, choose the underlying holdings, we'd use a lot more kind of passive or index-based stuff for that. But then that would be the rebalancing. That would be kind of automating that piece. So we looked into it from there. What we found is if we were already going to do all the advising work, they might as well just be a full client with us, because cost-wise, it wasn't saving them much. If they're going to be paying for the advice, they might as well just have us manage it. Then at that point, it was like, well, are we making any money off of it when it's below our minimum? And you look at the cost to run our firm. So we did briefly look through it. And again, with technology advancements, we may circle back around, but for right now, we don't use it in any of our applications.
And personally, in a prior life, like when I just started out of college, I was not working here, and I did have a Roth through Betterment or something like that. It was simple, easy to use, easy to set up. Mm-hmm. It wasn't what I wanted to do long term, but it worked for what it was. So
it's like the step up between do it yourself and then you add just one layer of a little additional help. So it's like, I want to choose everything. And then if you're like, well, I don't know if I know exactly what I want to do, that's the next step up. It's like, oh, someone will at least help me in this program to say, hey, if this is your risk tolerance, here's what you should own. Yeah. So it's kind of that next step up. Mm-hmm. So yeah, there's a spot for it for sure.
Yeah. So also you mentioned Betterment. So what other type of robo-advisors are there out there?
That's just the one. That's like the biggest one.
Betterment is one. That's one we looked at. So like the big custodians, a lot of them have kind of offshoots of those. Yeah, like so
Fidelity
we look, Fidelity, Vanguard, I think had some stuff there for quite a while. I think
like Goldman Sachs, Marcus's branch has their own kind of stuff.
So a lot of the big banks and custodians, those have some sort of automated piece that if people want to step up from a free account where they're managing to have that a little help, they usually offer something. Betterment's kind of the well-known one. We use a risk tolerance software called Riskalyze, which helps us figure out what your ability to tolerate risk is. They actually had one that they were experimenting with on their own as kind of an option for advisors as well. So there's a lot. There's a ton out there to choose from.
There's this one app called Personal Capital where you can load they have one. You load all your accounts. Well, it's free to use that part, but they do have that sort of robo-advisory sort of management side of things, and sometimes even personal stuff on the side that's kind of an in-between as well. So yeah, I think that it's becoming very popular because for a financial institution, once you build the algorithm or whatever, it doesn't take a lot to manage it. So it's a very low-cost way to gather assets and get even relatively small expenses from the client. Well, it adds up if you have a lot of clients.
And I would say if someone listening is thinking about that, start with where your assets are at. So look at wherever you're currently investing and see if they do have an option, because it'd be a lot easier to utilize them if you're already happy with where you're at to see if they offer something like that.
Yeah.
Okay.
Good.
So my next topic is cryptocurrency.
Ooh, Austin's favorite.
Man.
So I guess open-end question again. What's your opinion on it?
I don't think the technology is going anywhere. Well, they're calling it like a crypto winter right now, where cryptocurrencies in general, have sold off 60, 70, 80%, sometimes more, sometimes 90%.
Luna, what was the one?
99 point some percent. So a lot of the easy money, the retail money, has been flushed out of the system. So only like the hardcore people are still holding it or buying it at this point. The technology, I think, is only going to be growing. I think something that's particularly exciting is the Ethereum merge from proof of work to proof of stake. It's going to be happening in September of 2022, where it's going to become a lot more environmentally friendly, where you won't have to spend big bunches of energy to mine new Ethereum. You'll be able to do it through a staking process, essentially putting up your Ether to validate the blockchain. Yep. That was a lot of big words in one sentence. But that's something I'm particularly excited about. As far as a quote-unquote investment, I still think it's rather speculative, although even more hardcore crypto people think it's stupid not to. I'm like, Like, I don't think it's going anywhere, but we're still way early. So there's going to be a lot of risk, and I still consider it more of a speculation than an investment at this point. That being said, I dabble myself. I'll put that on record, but not a lot. In consideration of my overall financial picture, I keep everything in line with risk and keep it a very small amount of my assets. So, I mean, I think the space is fascinating, but I have not bet the house on it.
There you go. Being a compliance officer, I like regulation, and that is an unregulated area right now.
Yes,
cryptocurrencies has really no overseeing government institutions. So, like we have the SEC. Yeah. Regulating our industry. And so there's been some concern with that, because as that
stablecoin.
Yes, it was not stable, apparently.
It was unstable.
But there was been issues where maybe somebody who had a lot waited till the price went up and dumped, and they were the ones kind of propping the price up in a sense. Well, there's no one regulating that, and it's not illegal because there's no regulations to fall back on. So until there's some sort of structure there, it's going to be hard for most investors to be comfortable in that area. And that's kind of where I fall is, yes, I think it's here to stay long term. Which coins are going to be the ones that last, it's hard to say. And so from that standpoint, I fall in the same boat, is that we don't discourage people, but we strongly encourage them to minimal invest in that. Make sure it's not a make or break for your overall financial plan. If you're comfortable with the volatility, I can't say don't go in there, but you got to understand that like some of those coins, you could go down to zero. It could go to zero. And there's some risk involved, and you got to be careful with that.
And go in with a long time horizon, because this year is proof that, you can lose 60, 70% of assets in a couple months. And if you believe in technology, that's great. It still just may take years. Yeah. Get back to where it was. Who knows?
And you could still bet on the wrong coin, and the technology could last, but
that one's done.
Yeah. So just be careful is what I say.
Yeah.
That's a really good point.
Be careful.
Okay. One last question regarding cryptocurrency. Do you guys have a favorite cryptocurrency?
Oh yeah. So depends on how you're asking that question. Do I have a favorite? In that they have some fun names out there, because anybody can create this. I mean, that's the other weird thing about it is you can make your own coin and call it the Kate coin, and everybody would be
really
scrambling around for that. There's very minimal entry point for that. That being said, I think long term it's those early movers. So you got Bitcoin and Ethereum are kind of the two big ones. So when you ask them about a favorite coin, I think Ethereum, because of their ability to adapt and change, has a leg up on like Bitcoin, who's kind of stuck in how they process things. But I'm not saying you should invest in either of those. That's always the caveat, right, Austin?
That is.
This is not investment advice. But when it comes to it, I would say What you need if you are dabbling in it is volume, trade volume, meaning that if I do want to sell something, there's enough people out there to buy it that I can get rid of my investment anytime I want. And so those bigger coins do allow you a little bit more volume, that if I have a couple $100 of investment, at any point in time, I could sell that and have somebody out there to buy it. Right. Where some of these smaller coins that are new have less volume, and I could actually be drastically moving the price if I ever decided to divest out of there if I had a significant holding in there. When it comes to favorite coin, I don't have one necessarily. There were some funny named ones, but in general, I think ones with high trade volume give you at least the best flexibility to come in and out as you make your decisions.
Yeah, I mean, I would echo what Josh is saying. I guess favorite to me means a couple things because there's a lot of different technology behind it. I would say there's a couple categories of cryptocurrencies, and one is the digital store value category. And to me, that's always going to be Bitcoin. There's only ever going to be 21 million Bitcoin. It's going to be like a digital gold, quote unquote. You know, it's a very finite resource, and it becomes harder and harder to get the rest of the Bitcoin every single year as the halving occurs. So I think that as far as a store of value, Bitcoin will be the king player of that space. However, when it comes to transactions, that's where Ethereum comes. Ethereum is a much cheaper and easier way to digitally transact on the blockchain. And when it comes to things like NFTs, which is a whole nother ballgame, and we're not going to get into that. We actually have a whole episode on that where you can listen to our opinions on NFTs. But when you think about the NFT universe, that's essentially based on the Ethereum blockchain. So that's an upcoming and growing space as well. So transaction-wise, I think Ethereum's probably the most exciting. Store value-wise, I think it's Bitcoin. Mm-hmm. Neither of those are recommendations, but those are, again, like Josh said, the more established players, in my opinion, are going to be the ones to last through things like this crypto winter we're in right now.
By the way, a couple. So there's Garlic Coin.
Garlic coin?
Garlic coin, but it is based off of garlic bread. They wanted to create a coin off of the love of garlic bread.
It's delicious.
Yep. And then there's Moon Coin, which I found this one interesting. There's 384 billion coins out there of Moon Coin. The reason, though, that number's there is they calculated that's the number of millimeters between Earth and the Moon.
Oh, my. That's a really
that's how they came up with the number of coins they'd have available.
Obviously, Dogecoin.
Yeah. Well, yeah, so you got the Shiba Inu coin, which is another one. There's a Trump coin and a Putin coin, which are both out there hanging out. There's a pot coin and then the Dogecoin. So, yeah, there's some fun ones out there.
Did you guys ever invest in Dogecoin?
I never had a penny in Doge.
No.
Okay.
You?
Maybe a little bit.
That's all right.
We're not, this is a judgment for
speculation, right?
It's speculation.
There's nothing wrong there.
Some people made a lot of money on it.
Yep.
Yeah, some people did. Some people not so much.
That's right.
Which is okay. Again, if it's within
reason, you didn't need it,
it's a learning either way.
That's right.
So
tax loss. There you go.
Okay, well now I have my dad joke of the week.
Ooh boy, we're excited.
Been waiting since last Thursday for this.
What do you call two monkeys that share an Amazon account?
Ooh,
that sounds fun.
I got an answer, but I'm going to let you say it.
I don't even know.
I do.
Primates.
There
Primates.
you go. Primates.
That's
I like
hilarious.
I got it. There you go. That's
good. Do
you
you guys know that there are like 100 million Amazon Prime accounts in the United States?
Wow. Of 300 million people, 300 and some million people. That's impressive.
Isn't that impressive?
It is.
I mean,
that's a lot.
I have an Amazon Prime account.
I have an Amazon Prime account.
Your family probably has an Amazon Prime account, or you do?
Mm-hmm.
Yep.
So therefore, there we go. There's 3 out of 3.
Yeah.
So I use it all the time. I love Amazon.
Yes. In fact, we were on vacation this last week, and we had to have a neighbor pick up some packages that got delivered, so they weren't just sitting out. It just never ends. Even when we're gone, we got stuff showing up at our house. What is happening? So, it was toilet paper. We have an automatic
of course.
Delivery. Oh,
well, when you have that many kids,
I mean,
we go through it.
Just anything you can automate.
I know.
So nice.
Subscribe and save.
I know,
you
right?
save like 20 cents a roll.
You do. Things you think about when you become.
That's right.
Yeah.
Or like wipes and diapers.
Yeah. Oh, it's crazy.
Yeah.
Okay, so my next topic is IRAs.
Ooh.
So if I wanted to open a Roth IRA, what's the best way I should go about doing so?
Yeah, good question. So, couple rules for the Roth IRA first as we walk through it.
Define it.
Yes.
Individual retirement account.
IRA stands for IRA, Individual Retirement Account. Yes.
Yep.
The Roth IRA, the Roth piece is a newer caveat to the IRA that they allow you to put money in after you've paid tax on that money. And then as a result, since it's already been taxed, it grows tax-free for the rest of the time it sits in that IRA. When you take it out, no tax is owed. It's great. So a couple rules is, one, to open a regular Roth IRA, you have to be 18 years or older. So we're just going to assume you're an adult, 18 years old. You can open one up at any time in your life, no matter what. To add money to it, you have to have income. You have to have earned income, meaning from a job. So as a result, you can put in as much as you earn or $6,000, whichever is less. So if you only earn $4,000, that's the most you can put in. If you earn 12, you can put up to 6 in. So the lesser of the two of those, and it's per person. So IRA, individual retirement account, each person can have one of these tied to your Social Security number. And so the idea there, though, is it's money that's going to be growing without tax forever, for as long as you own this. It's a great vehicle. And so how do you go about doing that? Pretty much any custodian, meaning where you would hold these accounts, will allow you to open it. It's very simple. The questions are pretty much exactly the same as any other account type. They just want your name, address, Social Security number, those type of things. And then the contributions that go in, again, I mentioned you have to have income. The custodian doesn't know or care. It's when you do your taxes is where that matters. And so opening a Roth IRA is pretty simple. You just go to wherever you want to. There's Fidelity, Schwab, TD Ameritrade. There's all these custodians out there. Vanguard, like I mentioned, Goldman Sachs. Anywhere you want to open an account, the process is very straightforward. Nowadays, online, you can do it just clicking a button really quick.
I bet in 5 minutes you can have one open.
Oh, yeah. Once you open it, then ideally you want to link it to a bank account so you can make contributions into it. And we always say, automating things is great, making those habits in place. So the best way of doing this is setting up a reoccurring contribution. So let's say you want to put $500 a month in, that gets you to $6,000 for the year. That's a great way of maxing it out. So you just say, hey, every month I get paid on the 1st of the month. Hey, on the 5th of the month, move $500 over there. And so you make your monthly contributions in while you're getting paid. That's how you do it. And then investing it makes the most sense. If it's going to grow tax-free, you'd love to earn some money on it instead of just having it sit there. Deciding how to invest it is where an advisor would come in to say, hey, what are my goals? When do I think I'm going to use this? And what kind of tolerance do I have for the market? And that's then would help you decide how to invest it. But the cool thing is, if you put in, let's say, $6,000 that first year and you just never touch it, and then when you're way out in retirement, it's now $1 million. You don't owe any tax on that because you pay tax on $6,000, but now you have $1 million, and that the rest of that money is tax free. So that's the coolest thing about it. So the younger you are, the more advantage you have that Roth can give you from a tax free standpoint.
And as far as your investment choices go, if you open up one just to manage yourself, you can really invest in anything you want, whether that be individual stocks, theoretically bonds, mutual funds, or ETFs. Yep. If you're going to be dollar cost averaging, like what Josh mentioned, where you're periodically putting money in, a very easy vehicle to be doing that is through the mutual fund vehicle, where you can buy $500, not shares, a month, and automatically buy the same fund proportionally and automatically reinvest the dividends back into the fund as they come in. There's a lot of things you can do to make it just kind of go automatically once you set it up.
Yep. And the big thing is, like all IRAs, they're designed for retirement. That's the R in the IRA. And so they have some rules in place that if you touch some of this money before you're 59 and a half, which is what they're using for retirement age, there's some penalties involved. And so with the Roth, there are some caveats. Since you've already paid tax, you're always allowed to take your money back out. So if you put in $6,000, you could take $6,000 back out and there's no penalty. But if you ever take out earnings, that's where they're going to start penalizing you. But again, any money you put in there, think, I should not need this until retirement. And that's kind of the mindset you should have with a Roth IRA. There's some caveats there for first home purchases and education stuff, but more often not, we advise or encourage them to try not to touch that, because you can only put $6,000 in a year. And so if you take that money out, you lose that chance to grow. You can't put it back in later.
So earlier we talked about Robo-Advisors. If I were to open a Roth IRA, should I open it through a Robo-Advisor or should I go through a custodian? What's your guys' opinions on that?
It just depends on how involved you want to be. Do you want to be the one choosing what's in there, or do you want someone else to be doing that? That's really the only difference between the two, is if you say, you know what, I'm not comfortable making all those decisions on my own, then you'll want some form of advisor, whether it's a robo-advisor or a financial advisor or whoever it is. You'll want someone to help you along the way. If you say, you know what, I feel pretty good about choosing my investments, I'm going to find something big and diversified and not worry about trying to be too picky, choosing individual stocks, things like that, then you could do it yourself and just buy some big index fund that's buying the whole market and you don't have to worry about it. So it just depends on how involved you want to be. And there's really no wrong answer there. Again, it just depends on your tolerance. If you say, I'm going to be busy doing other things and I don't want to have to worry about this, then an advisor, whether it's a robo or a real advisor, would be beneficial. But if you say, you know what, I kind of enjoy this, I would like to be paying attention and choosing and buying and selling, then you can do it yourself. In that case, you just open one up for yourself. Whereas if it's a robo-advisor, you'd have to go to wherever that robo-advisor is and open it there. So just the difference. No right or wrong answer there.
All right.
Agree.
So what should you do if you are getting close to retirement age and have very little knowledge of the financial industry and have no retirement accounts or investment accounts?
Oh, that's a good question. And unfortunately, that happens a lot. We see that often is by the time people get past all the craziness of life, raising kids, doing all those things, and they finally have time to look around and start thinking, it's late in life, right? And so the first thing you need to do is start educating yourself so you understand the why behind everything. Advisors are great. Financial advisors are great because they can help with that process. But again, if you're a do-it-yourself and you're wanting to just learn on your own, there's a lot of books out there that provide really good help. There's one actually sitting right in front of you to help stack your microphone while we're talking to you.
That is a good book.
It's called Simple Wealth, Inevitable Wealth, and Nick Murray's the author of that. But that's one that it just walks through kind of the reasons why investing matters and compounding is helpful, those type of things. But there's a lot of really good books out there that just help you understand why. And then once you get the why, you then have to start saying, okay, how can I do that? What are the options available? Do I have retirement options at work? Maybe there's a 401k there that you just never used that you can start getting into. Or do I have to invest outside of work? Do I have other assets that I can use to help me get me started? Maybe I have rental income from different things, and that's an investment. Maybe you never looked at it that way to actually start putting your mind around your overall picture. And once you do, you may realize you're better off than where you really thought. But in general, it's educating yourself and then just getting a plan. Once you start getting a plan in place, that'll then tell you what do I need to do? Like, where am I going? Then you work back to what I need to do now to get there.
And I would jokingly say, and I say this with all jokes, that if you have no accounts and you're thinking about retiring, so first of all, Social Security is realistically not probably going to do it.
Yep.
Second of all, hope for family money. Very well.
Wanting to retire, once you get your plan, you'll see what does that look like. Because I always say anybody can retire at any time. You just may not like the lifestyle that affords, right?
You might live on the street.
Yeah.
But the idea there is if you say, I want to retire soon, that soon will then be directed by the plan to say, well, how soon can I retire if I really get serious right now? So you can start at any point in time. And what you said about Social Security is right, is that it's designed to just cover the minimal so that you're not destitute, right? Most people use Social Security as a portion of their retirement, but it should not cover 100% of your retirement. It's not designed to do that.
Your living style would be very low.
Yeah, I think the max you can get is like $4,000, something like that. I mean, it's not a lot per month that you can get out of Social Security, even if you put the max amount in every year, which means you were a high earner, means you probably have a high lifestyle standard, and which means it's not enough for you.
Which means you hopefully were saving.
Okay, so how much of your income should you be contributing to your IRA monthly?
Yeah. So in general, whether it's your IRA or 401k or any kind of retirement, the rule of thumb was 15%, but because people are living longer, it's working its way up to 20%. We kind of encourage that 20% number. And it goes back to when we were talking about budgeting in our budgeting episode. I kind of said there's a 50, 30, 20 kind of high level budgeting. 50% of your budget should be towards your fixed expenses, things that you have to do, mortgage or rent, utilities, those type of things. 30% goes to your discretionary spending, which is all the fun stuff you want to do, or things that vary. So like food, things like groceries, eating out. And then that 20% is your savings. And so that's kind of the high level budget that you can use. So that 20% number is kind of the target I think you should use. It really depends on, again, where you're starting. If you're young, the more you save, the better it's going to be, but you don't have to save as much if you're kind of just looking at a standard living lifestyle and time frame. If you're 40 or 50 and just getting started, that saving number is going to have to be higher because you're playing catch up.
You thinking 20% pre-tax or post-tax?
if you put it in a 401k, that's your pre-tax money. The 20% is really post-tax in that when you look at your budget, you're budgeting off of post-tax money. And so it's really 20% post-tax. But if you're factoring in your pre-tax 401k, most of the people use that number. And so you're somewhere close to there. You know, it's not going to move the needle too much. But in general, if you're budgeting using the 50-30-20 and you're looking at as your take-home, it's after tax.
So I have one last question.
Bring it.
What is your favorite stock and why?
Ooh.
We're going to also reiterate, these are not recommendations.
Yes.
Josh, you just knock our socks off.
Oh, man. Favorite stock.
Best ticker.
Oh, well,
what Josh likes.
I love a good ticker. I love a creative ticker. Like, for instance, Cedar Point or Cedar Fair, the owner of Cedar Point, their ticker is FUN. Fun.
It's a great ticker.
That's a great ticker, right? But when I look at favorite stock, I think, it's going to be Microsoft for me. They make a product that people need, and it's, Word, Excel, all the stuff that you want, Windows, everything that you think of in a computer, especially business related. And they pay a dividend, and they have the new software as a service, which means you have to pay a subscription, which means they're getting money every year from everybody, which as someone who pays it, you're like, frustrating. But for a company, it's great revenue. And so from a long term, they've been able to adapt as technology has changed from big PCs to laptops to tablets to be able to take their software and incorporate it. I mean, it's on my phone. Right? It's everywhere. That's a company I like. Again, not an investment recommendation, but I like that stock.
I'm glad I let you go first because that gave me time to think. Because I really had two in my head, and I'm not going to say them. Okay, I might say them both. I don't know. I would say my favorite stock right now probably is Amazon.
Amazon. Because of all the monkeys living together that are primates.
Primate.
Yes.
Yeah, I mean,
when you look at what the business does, obviously as a consumer, I love their retail e-commerce business. Now, that's not a great money maker for them, but from a consumer standpoint, it's fantastic. But from a money-making standpoint, from a growth standpoint, their Amazon Web Services product is state-of-the-art. And it is growing very quickly, and it is extremely profitable, and it's really what the big companies go to when they're looking for web service products.
Yes.
So that's probably my favorite stock. Now, close second, again, neither of these recommendations, Disney. And I've been bullish on Disney. I like Disney, and in fact, I've liked it for a long time. But they are the content kings of the world.
They have everything.
They own Marvel. They own Star Wars. They own everything. ESPN, Disney Plus,
ABC.
Hulu. It's all and then with their streaming services. And then you've got the parks. And the parks are cash generating machines, as
crazy.
Josh knows.
Cruise ships,
everything. So. I like Disney too. It's not my favorite, but it's right up there. Those were the two I was going back and forth between. But Amazon's mine. Kate, we're going to turn this on you.
What about you?
What is your favorite stock?
oh boy. I would probably have to say Apple.
Okay.
Yeah.
I say
That's a good one.
Apple.
You're an
because-
Apple product user.
Yep, I am an Apple product user.
Sorry, Josh.
They know how to suck the money from their consumers without
great.
them knowing it.
Oh, yes.
I know.
Yeah, and they just make a lot of money. They do very well.
Yeah.
Yes, they do.
You're going to get that new iPhone? It's coming out.
And they have a
here in
lot of
September.
cash.
We'll see.
They have a lot of cash, too. And so
Yes.
from a stability standpoint, they can ride some volatility without too much worry.
And this whole year's been crazy for the stock market. And a lot of stocks are down. Well, Apple is not far. It's rebounded very well. It's not far from its all-time highs.
There you go.
So, again, not a recommendation, but thank you for your opinion.
Yeah.
Yes, good choice.
As an Apple consumer,
Yeah.
I go to the store and eat apples,
Yes.
right? Apple product consumer.
There you go.
I live in the Apple ecosystem, and I like to poke Josh because he rebels against Apple.
I'm looking
As he's
at
looking
this
at an
on the
iPad.
radar. I have one.
He has one. It's okay. Well, Kate, that is super exciting. We're just thankful that you were able to take some time to join us for this episode, and we're thankful for what you do here at the firm for us.
Very.
'Cause
Yes.
we just couldn't do it without you. It's absolutely wonderful. So thank you for taking care of all the fun back of the napkin, back end of Morningstar systems, fun things that you do, because it's a hard job, and you're doing great at it. So thank you for what you do.
Thank you. Thank you for having me on the podcast.
Yep. And also remember, follow us on social media, Instagram, Facebook, Twitter, all the fun stuff for theinvesteddads.com. We try our best to post things on there, and we're getting better at it, I'm going to say.
That's right.
That's right. We have reels now.
They're not fake.
I don't know. Apparently they're on there. So, but check them out, join us and follow us along. And then if you have any questions, like Kate brought some great questions today, shoot us an email and we'd love to answer those for you on a future podcast.
All right. Well, until next Thursday, have a great week.
Talk to you later.
Thanks. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hixon Zuercher Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hixon Zuercher Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hixon Zuercher Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.